Okay, you guys, this is being recorded. Something I mention at the beginning of every single webinar, like I'm beating a dead horse, is watch this again. Maybe not necessarily this specific one on the roadmap to trading options, but, another synthetic long stock webinar, because it'll help you guys really remember some of the nuances in and around this strategy a little bit longer. So it's important that you do it relatively soon afterwards, because if you wait down the road a month or so, it's going to be like learning it over again. Whereas right now it's pretty fresh. It's like in college when you would study and then review your notes afterwards, you had a tendency to be able to remember that a little bit longer. Greg says he's from Newport Beach. Oh yeah, that would be a nice place to be right now with the surf. Get my board out. All right, so without further ado, let's get on with this. We're looking at synthetic long stock. So this stock or this option strategy will act just like a long stock position. No, you're not going to get a dividend, but dollar for dollar moves is how this is going to work and how we're going to kind of play this out. Let me get a couple of things out of the way real quick though. My name's, for some reason, why isn't it switching? There we go. My name is Eric Wilkinson. You guys might recognize me from mainstream media where I've talked about the economic data, geopolitical environment, how that impacts the overall markets with my market analysis. Well, in my daily market commentaries, I do the same thing, but layer on top of it these option strategies that I'm teaching you in these webinars and following these guidelines that I will lay out here, okay? So in these daily market commentaries, though, I'm talking about the trades that I put on any given day, when, where, and why I'm putting those on, win, lose, or draw. I'm not cherry picking. It's like literally we are going through this on a daily process. When I decide to do something, I let you know immediately what I've done, and then when I take it off, whether it's a winner, a loser, or a scratch. And also I go into it even further on those ones that I'm losing money on. I show you guys how I'm staying mechanical with it, lowering that overall cost basis on those different trades that might not be working out. And you can learn from that as well. So whether it's covered calls, selling some puts, the dollar cost average, all of those things are in those daily market commentaries. So it's a little bit more portfolio centric, if you will. Whereas these, we're talking about how we come up with this strategy around our assumption we come up with, right? Because usually what we're doing is we're looking at charts or we're watching TV and we figure out that there's some directional assumption due to all of the inputs that we have into our head. Well, now we got to figure out what strategy is best for that particular assumption and that underlying. So we do that. I'm trying to do that in these webinars, particularly where we kind of go through that same thought process. How you doing, Alexander? Anyway, in that time, for the last 25 years, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I actually started out in college trying to get a psychology degree and then switched it over to finance when I started trading there. And then after graduating with a finance degree, I drove straight up to Chicago and started working on the floor of the Board of Trade. So I traded just about every market condition there. Anyway, you can follow me on Twitter at Wolfman's Blog. Our parent company is at ProTraderStrat. So all kinds of snark and stuff like that. I tweeted something. I don't know if you guys saw Elon Musk tweeting out again today. So I tweeted something out because I bought some puts in Tesla today. And he was ranting about the short sellers. I didn't short him, but, in a sense I did. All right. Anyway, also follow us on Facebook at ProTraderStrategies.com. The reason why, we're putting out tons of content there. So if you want to see a few of these daily market commentaries, you'll be able to see those there. Obviously, if you are a member, then you will be able to get those access to those much quicker and more consistently for sure. All right, so we do know, because you guys signed up for this, right? We're doing this on the synthetic long stock. One thing I want you to do right now, though, is take that synthetic long stock and kind of shelve it for a little bit. Why? Because I want to go through this process. It's not like every given day you come out there and go, you know what, I'm going to put on a synthetic long stock. Well, you might actually, if you have a portfolio and you like to build long-term portfolio directional trades, well, if you don't have a lot of money in that portfolio, this could be a way to supplement just going out there and buying that stock. You, like I said, you're not going to get a dividend, so don't rely on that. If that's part of your income stream, this isn't going to work out for you there. But with this, that being said, if you have a smaller portfolio, because we are going to have such reduced margins in order to build this strategy out, you can have a more diverse portfolio. And you can probably afford a stock that you might not otherwise be able to, like a Facebook or something like that, where that could be a bit of a margin hog in anybody's portfolio. So let's shelve that for a minute. Now we're going to be doing this roadmap to trading options, right? And what we need to know is our roadmap key. And I know a lot of you guys out there that are already hitting me up in the questions box saying hello and everything have heard this, but it won't hurt to really drill this down a little bit more. Prashad, I have a reason to believe mRNA will pop later this year. Vaccine success. How would you play this with options? All right, well, you know what? Remind me when we get moving down that we'll go through a couple of different scenarios, and we'll try and throw that one in there towards the end. So remind me, all right? Because it'll probably scroll off and I might forget about it. All right, delta. Delta is the effect of the option premium in relation to the underlying, okay? So this is very important. When we think about we go out and buy a stock, we buy a 100 lot, right? And we buy that 100 lot of the underlying, that's equivalent, meaning, so what happens is every dollar move higher in that underlying when you bought the stock, you get $100, right? So with delta, what it tells us is for every dollar move higher in that underlying, that's how much our premiums are going to be affected. So in a sense, it's not always going to be dollar for dollar. We're going to be looking at something that we'll go over to the option montage here. So if you hear me talking about the option montage, it just means the trade window here. So I'm just going to randomly pick a monthly expiration here. And what we're going to look at here is, let's just look at the out of the money calls, for instance. All right, so right now they're $13 and $13.30. This is Facebook. All right, the delta is 51. All right, so that means that when this underlying moves up by $1, that corresponding premium for that specific strike is going to increase in value by that. Now, with this, all of these definitions are assuming a positive move in whatever we're talking about, like a $1 move in delta. You know, theta goes by a day. Volatility increases by 1 percentage point. Okay, so let's get that out of the way. But in this particular example, if Facebook went from 23, or I have a habit of like chopping down the number, like saying 23, 233, 233. 233, it goes from 233 to 234, 234.42. So an exact $1 increase, okay, just to try and get these apples to apples. Then what would happen to these corresponding calls over here, right, on the 235 calls would increase by that 51 cents. So now we would be looking at the bid would probably be somewhere around $13.51, right? And then the offer would be somewhere around $13.81, okay? So it's going to increase, you know, in respect to that. Now, if we look over at the delta on the put side, you can see that delta over here is negative because it's assuming that it's a positive move, right? So in that regard, a plus $1 move higher plus a negative delta means that those premiums are going to decrease by the corresponding delta, okay? So in this case, then the bid for the 235s, let's try and stay consistent here, 1435 minus the 50 cents we're going to be looking at somewhere around $13 and what is that? 84 cents. $13.84 decrease. And then these would, on the offer, $15.05, we're going to be looking at, they would then be $14.54 or 56 cents, right? So they would decrease by that value. Vice versa, if you got a negative move or a minus $1, it goes down by $1. Well, a negative dollar plus a positive delta would make that a negative delta, and you would subtract it, okay, from the premium. And vice versa on the put side, a negative $1 move plus a negative delta would make that delta add in. Negative plus a negative makes that a positive, so that would be a positive for that. Okay, so that's delta. Delta moves in relation. Then obviously these out here are only further out the timeline, are going to be a lot less. And then the ones that are deep in the money are going to be very close to dollar for dollar of what that underlying is doing. Excuse me. So keep that in mind. Further away, out of the money, delta is much less. Deep in the money, as you can see here, delta is much greater. All right. Those less. All right. So that's delta. It affects our options premium in relation to what that underlying is doing. Now gamma just goes with delta. All right, so gamma, let me get out my other pen because I don't want to have to keep pulling up my thing there. Should have had this ready for you, but I was running a little late. Highlighter, ink color, let's go black. All right, so delta just goes with, gamma goes with delta. That's how we're going to remember this. Delta is data, gives us all kinds of information. It's not just the option premium increasing, you guys. It also has probabilities of being in the money and stuff like that I'll touch on throughout this webinar most likely. But delta tells us like 6 different things that we can figure from delta. Now gamma goes with delta, right? So this is dollar number 1, right? So think of gamma as dollar number 2. Okay, so delta is affected with gamma on the second dollar. Gamma goes with delta. So when in that last example, when we were looking at the premium there, the first dollar move, we already talked about it. It was increasing by 51 cents. Well, on the second dollar, it's going to increase with the gamma 52 cents. All right. So in our first premium here, increased by $1. We went to $13.51, right? And the offer was $13.81 on that offer there. The second dollar move, let's just make it yellow. So that was on dollar number 1. The second dollar move, then our premiums are going to increase by 52 cents. So now we're going to be looking at $14 and $14.03. And then the offer is going to be moving up to $14.33. Right? Okay, so that second dollar move, gamma adds into the delta for that second dollar move. So it's going to continue to do that. And same over here on the put side, a second dollar move. Remember, we had the first dollar decrease those premiums by 43 cents. Well, a negative plus a positive, the second dollar move higher is going to increase the premium only by 42 cents. Okay, so it's going to start slowly dwindling away. And I'll probably, let me try and find a better example where we can actually even visually see that. Usually on the smaller dollar denominated ones that get like, let's just go here, see if these are dollar increments. These should be dollar increments. They are. All right, so we can even see it right here. So when you see it, it's 48 cents coming out. On the second dollar move higher, it's only 44, and that's that gamma coming out. you can see if you just kind of draw a line, you can see how that gamma has pushed out of those, right? Here it's a little bit wanky. It went down by 3 cents, but that's going to be a rounding error because remember, these decimals go way out. And then here again, you know, first dollar move would be 49. Well, we can see gamma affects the premiums and adds into that for the second dollar move. And of course, that first one was 3 cents again. But again, that's a rounding thing. You can see it's very close. 4 cents goes in there. And then 3 cents, you can see here, it's again, now that's you're like Wolfman, that's a 4 cent difference between these two. And it's saying the gamma only added in for 3 cents there. Well, again, that's a rounding area. It's rounding it up to 59. It could be 59, 47, blah, blah, blah. And the 63 delta is actually 62.9 something around or what. So those are rounding, but that gives you an idea how that works on the gamma on the second dollar move there. And vice versa, if you wanted to go on the negative, you could flip it. All right. Hopefully that wasn't too confusing. So gamma goes with delta on the second dollar move. That's really what I want you to come away with that. And theta is just the thief. Theta is the thief. The thief in the night that comes and steals our premium. So theta impacts our premium as a time value. So every day that goes by, basically that theta comes in and just nips away at our premium. So we'll see it go down, over the weekend. It's going to continue to eat away. Not that you can do anything about that, but it will continue to eat away. So basically, if we were open tomorrow, we would see 4 cents come out of these premiums. If nothing else changed, volatility didn't change, the price was exactly the same. Just on the open, if we opened up exactly where we closed, we would have seen just 4 cents come out of our premium. So theta is the thief in the night that steals our premium. And you can see theta is always negative, all right? Theta is negative because you can't go back in time. It's going to always eat away at it. Now, theta can work against you and it can work for you, right? That's the beauty in this. Same with delta. Delta can work for you and work against you. If you bought it, it can work against you, right? And if you sold it, then, it can also help you out. If you sold it and you were directionally right, then that delta coming out helps you. Theta, every day that goes by, you got to just think, well, if I bought it, it's going to hurt me. And if I sold it, it's going to help me. All right. So those are our ways. I'm trying to lay this out for you guys because we're going to go through this thought process and you're going to have to think, okay, how do I want delta to work in my favor? How do I want theta to either help me or, make sure I can minimize it? And volatility, what's that going to do to me? So we need to kind of go through that process when we're deciding on this directional assumption we've come up with, what strategy is going to be the one that is, fitting or the best fit, I should say. All right. And Vega is the measure of change in, measures the change in volatility. Vega measures the change in volatility. And what that does is it's still a penny or a dollar denominated type of instrument. And what we're looking at over here is the Vega column. And we look at this number right there. All right. Now, when this goes from 30.93 to 31.93, okay, just to make it sure it's 1 percentage point, because I don't want to have to like chop a Vega in half, a 50 cent increase or a 0.50 basis points is all I can think of. You can tell I'm a bond guy. Like a half of 1 percentage point increase, then it would actually, increase by half of the Vega. And I don't want to confuse that too much, but it was in my head. So a 1 percentage point increase in Vega, then these premiums are going to increase. You can see it's positive, so they would go up by 16 cents. So these 106 puts, just all else being equal, the underlying didn't move. We're not looking at this tomorrow, but right now, in this second, we just saw an uptick of 1 percentage point. Then we would see the 106 puts increase to $4.56. The offer would go to $4.81. Okay, and vice versa over here on the call side, same thing would happen. 16-cent increase. These same 106 calls would then increase to $3.91, and the offer would be $4.16. All right, so that volatility increase affects those. Now, what happens when we do a negative, right? It goes down by 1 percentage point. Well, then you subtract a negative plus a positive Vega, negative move plus a positive Vega makes that negative. So then we would take that premium or that corresponding Vega out of our premium. All right. Pretty simple so far. Everybody with me so far? All right, good. All right. So now that we got our roadmap out of the way, we understand our Greeks, even though this isn't really a Greek, that's stolen from Gamma. So if anyone wants to try and call me out, I already know. But Vega is really the only one that's not a quote unquote Greek. And but so deltas, data, it affects our premium by a dollar move. Gamma goes with delta on the second dollar move. Theta is the thief in the night that comes steals our premium volatility. You know, for every 1 percentage point increase, our premiums jack up by that corresponding Vega. Vice versa, a negative move in Vega correspondingly takes away. Now, with this strategy, we need to understand where are we going, all right? And I don't usually like to cherry pick trades, and I don't even know if this is really a cherry pick because I haven't put this trade on yet, but I'm considering it. So my idea here, though, is let's just say we are over here somewhere in LA, all right? And I've come up with this trade, and I'm looking at XRT, all right? So I'm going to look at XRT. It can be XYZ, however you want to think about it, but I'm going to try and build this out with a specific example, all right? So XRT, let's just say XRT is right here. XRT is right there. I have a bullish assumption in XRT. It's a tech ETF. I think that even though we're in this whole environment of everything going on, I think that the tech sector is going to do very well. If you watch the daily market commentaries, you've heard me pounding this since day one of this breakout, is that if anything, tech is going to end up doing very well. So with that being said, XRT, I've got a bullish assumption, right? So obviously, I think it's going higher, all right? So now we know where we're going. We have to figure out a couple of other things. We know we're bullish in this, so I'm obviously wanting to find a bullish strategy going on. And now what we need to find out with that bullish assumption, we already talked about it, we got a higher move going. We need to find out, you know, do we have a good destination? Is XRT, where we're going, is that a good destination? What I mean by that is there a lot going on in XRT? Well, it's an ETF, so you might be saying, yeah, obviously everybody's heard of XRT, and maybe you have or maybe you haven't, I don't know. But anyway, what I want to say here is a lot of things going on means there's a lot of interest. There's a lot of open interest in that underlying. That means there's a lot of trade going on. And what happens when there's a lot of open interest and a lot of trade going on? Well, it means that there's free market price discovery in full swing, all right? That means people are fighting each other to get their trade off. It's like, you know, if you go to a one-horse town and you're buying gas, that guy can set the price wherever he wants, and he's not going to budge. But you go to a place where there's like 10 gas stations, and then all of a sudden he looks over at his neighbor, and the neighbor drops the price by a penny. What's he going to do? Move it higher? No. He's going to try and at least match it and maybe better it by a penny, okay? So that's free market price discovery on our road trip. And we don't want to hit that one-horse town where the guy's like, yeah, gasoline, I'll sell it to you for, $4.50 a gallon. And you're like, dude, I just left the town like 30 minutes ago and it was $1.50. Like, well, then drive back there and get it, right? So the same thing goes with stocks. If there's one person in that option montage making markets, he is not very likely to give up an edge to facilitate your trade, all right? But when you're in something like Apple or Facebook or whatever, and there's tons of people in there, there's a lot of open interest, that means people are kind of keeping an eye on it, right? They're making sure that they are, pricing accordingly. So that's the same with this. When I mean a good destination, what we need to figure out is XRT, does XRT have a lot going on? I mean, you can see there's a lot of roads there. There's probably a lot going on. So another thing we can do is go over and look at XRT. I think I had it already up. So our rule of thumb here is, and we've gone into a weekend, right? Basically, we're going into the weekend. So this is a little bit wide. But what we want to do for a stock that's over $100, all right, what we do is we go over here and we're going to move the decimal 3 ticks to the left, all right? So basically, we're looking at 10.5 cents or 10 cents. So what we want to do is look down here at the option montage and these ones that are just out of the money, and we're a little bit farther out than the spot month. The spot month is probably still that closer duration. Only got 15 days. People are going to be rolling out to these, but my rule of thumb is you look at the spot month, the one that's has the most eyeballs on it, which is usually 35 days to expiration. That's where you really see the consolidation of everybody. But we would want to see these 10 cents wide to the bid offer. Now, I had a feeling heading into the weekend that this was going to be the case. So I did do a snapshot of XRT. I'm going to try and cheat a little bit and pull this down. All right, so we can see that this is the spot month and 15 days to expiration. $10 wide is that rule I talked about. You can see right here, we are well inside of that rule. Now, after the close, especially going into a weekend, everybody cancels all their orders. They're like, I'm out. I don't want to ride this out. I don't want to wake up on Monday morning late and then all of a sudden getting filled on all these trades I forgot to pull. So usually when your platform gets the signal, the market's closed, it automatically cancels everything, unless you have it as a GTC. And these days, people are doing GTCs. So you can see that fits that rule. Now, when we're looking at a stock that is less than $100, find something less than $100 here. I don't know. Let's look at eBay. Less than $100, basically, it's equal to or less than 10 cents wide. So we do the same thing, go down here to the option montage, make sure it fits that rule. They're, for the greater part, they are equal to or less than 10 cents wide. So when we're talking about like a roadmap here, let's just build a stoplight, all right? So my rule, if it is, less than $100 stock, if it's a XYZ, let's just call it XYZ is less than $100 stock, then it needs to be equal to or less than 10 cents wide, all right? That's a green light, all right? Let's just say ABC, is trading 239 cents, okay? That stock is 293 cents, 3 ticks to the left. Now, stock that is greater than $100, we do that decimal place move. and it needs to be somewhere less than or equal to, let's call it 24 cents and do the rounding, right? 24 cents. That's a green light there. All right. So if we're looking at something outside of that, because not all of these will always work. And if you are used to trading a stock that is a little bit wider, now the beauty with this strategy is we don't usually have to worry about this because I've got another little floor trader hack that we can figure out to see if the pricing is correct. But this is, general rules of thumb. If it is 2 times the rule, then that makes it a yellow light. All right. And if it's 3 times the rule, either one of those, 3 times that rule, then I would say there's just not enough going on to enter a trade. Now, you can't always follow this to get out because we're already in the trade. But the idea here is that we don't want to get involved in a underlying that doesn't have a lot of participation going on, a lot of open interest, a lot of volume. Yes, you can go and look at the volume and open interest and stuff like that, flip back and forth on different screens or add it to this one. I don't have a problem with that at all. What my theory is here is that if you know this rule, then you can easily just look at the stock price and say, all right, it's less than $100. It's got a bid to offer is pretty darn close to 10 cents wide. It might be 11 cents. Okay. That doesn't necessarily make it a yellow light, but whatever. You get my idea. It's less than or equal to 10 cents. That is like, hey, we got some solid markets here. Or if it moved the decimal 3 ticks to the left, that's a solid market. And you will generally see that even if I flipped over to the option montage from here to the volume and open interest, that these markets have some pretty good volume and open interest on any given day. The ones that are, and we're looking at the ones just out of the money because that's usually what people are trading or right at the money. And you can see, obviously, further out, there's still some decent volume and open interest here, but a lot of times you'll see that slow down a little bit. The daily volume might be a little bit lackluster, but that's because people aren't out there trading. But no, they are still they still have interest in those months. If there's a lot of volume and open interest, it's fitting my rule. They're going to be keeping an eye on those back ones as well. And there's probably like calendar spreads in there, all right? Or diagonals. There's all kinds of different strategies that are in the weeds out there that you're not necessarily seeing. They might be a little bit wider, but today was a perfect example. I did a trade and I went mid-market and bing, it was like I got hit on the first one. And I always talk about cancel replays, go to where you don't think you're going to get filled and cancel replays. Well, this was a situation where, there was an algorithm out there trying to leg maybe somebody's calendar or somebody's diagonal, whatever, and it wasn't able to show a price there because, it gets a little, highbrow right here or high level trading, but a price can't be represented if it is trying to auto leg a spread, but I'm leaning on a lean. All right. So somebody else's, what I'm leaning on to trade, I know I can see that there's a bid there, even though it's like in the weeds. And my algorithm will be like, okay, I can bid this if I see it because I can hit that one that nobody really sees, and then it'll flip. All right. You can lean on an outright. So if I was bidding an outright, somebody can lean on me because they know it's there. But then that one that is leaning on me, nobody can lean on it. Okay. So you can't lean on a lean. So that's how you leg spreads, or these algorithms leg spreads, is they will lean on an outright, which means that's an order that is not beholden to anything else. It's like you want to get out of a trade and you put an order in there. It's like, okay, that is an outright order, and these algos know that. And I have this spread. I can figure out the price. All right, so I'll show my bid here. And if somebody hits my bid, I can flip over and hit that guy's bid. I can sell that, auto leg that spread. But my bid that I'm showing, the next algorithm, it comes in, it was like, all right, that dude's leaning on something there. I can't really promise myself it's going to be there. All right. But once you come in with an offer outright, then you can be like, boom, boom, and it's done. So sometimes the price, what I want to say here is sometimes the pricing is a little bit tighter than what you're saying. So it might not fit that rule in the options that we're trading. All right, so we know there's a lot going on in XRT. So now we've decided, all right, we can trade options around this. The next thing, what we want to do is figure out what the environment is, right? We're taking a road trip. We need to plan this out. We need to know what we're getting ourselves into along the way. So usually what we're going to be looking at is low volatility or high volatility. Think of it as low volatility. The roads are clear. You can see for miles and miles. You're not going to have any stress. There's no stress on the trip. So, you know, the idea here is you can usually low volatility, take your time in getting somewhere. Whereas if it's high volatility, then, you know, you kind of want to streamline it. You want to bolt there, right? You want to get there as fast as you can or avoid that volatility as much as possible. Now, what do you do in something like, well, you got a mixed bag. You don't really know if volatility is going to come in or if it's going to be sunny. That's the beauty in this strategy is we can isolate these. We can make it to where we don't have to worry about this. All right. We don't have to figure what volatility is going to do. So, you know, let's just think of it this way. Well, my idea is I want to take a specific route. Okay. And so I don't care about volatility. Well, if you want to take a specific route, right, I want to track, and what I'm trying to get here is I want to track what that underlying is doing exactly. Well, you know, the idea would be like if I came up with, all right, you know what? I'm just going to take Route 66, right? And Route 66 is just basically, I want to follow XRT. I want to follow XRT exactly. All right. So I want to, you know, follow every move that XRT has. Basically what I'm saying is I want to have that stock. I want to have that specific underlying in my portfolio because I want to track it dollar for dollar. I don't want to just get 50 cents for every dollar it moves. And, you know, if you were thinking you were going to just go out and buy a call for this underlying and you weren't sure what volatility was going to do, maybe you thought volatility could come out and that would hurt you. Yeah, volatility goes higher, it'll help me, but I am worried about that volatility coming out and it might hurt me. And if it's, you know, like stocks kind of trade like this for a while, you know, our duration might be before it started climbing, right? All right. So in that time, that theta, that thief in the night, really kind of ate away at our premium. So we want to avoid theta, right? So is there a way to isolate volatility and theta? That's what we're starting to think. Yeah, I think there might be. You know, why does volatility matter? Because we've talked about this before, right? If volatility is lower and it goes higher in your buying options, that helps you. But if you bought that option and volatility went down, it hurt you. If you're kind of don't really know where volatility is going to go with XRT in the next few months, and you want to track it exactly, well, we probably need to start thinking, well, we need to isolate that volatility. And remember, when we buy volatility, we want to buy low premiums. When we want to sell volatility, we want to sell it when it's high premiums because volatility tells us where premium is. If volatility is really low, implied volatility, and we can look at it on the chart. When implied volatility is really low, you want to be buying it. When volatility is really high, you want to be selling it. Why? Because it wants to revert back to the mean. Well, what happens if you don't know what volatility is going to do? And in this case, we really don't know. And maybe we want to try and isolate that. Ultimately, though, with this strategy, and my assumption with XRT is I want to track it almost exactly. But this is something that usually comes into effect when we're trading any type of option, and you're thinking, all right, well, I'm going to be, putting on an option strategy. Do I have to worry about this? Well, actually, no, because what happens is we're going to be buying one and we're selling the other. All right. So we're going to be able to isolate that. I kind of gave it away a little bit, but the next thing we need to do is, what is our duration? Well, if we're going to follow Route 66, and if you guys watched any of my webinars, you guys know I'm a sucker for roadside attractions or like historical places along the route. Well, if I'm taking Route 66, I'm going to be hitting a lot of these, right? So I'm thinking I need to give myself a lot of time to get to Chicago. I want a long duration, right? So if you want to track something for a dollar for dollar move, like, you want to hold a stock in your portfolio, you're probably looking at a longer duration trade than, hey, I'm just wanting to get this little move. Now, yes, you can, maybe it's you're trading and you're like, dude, I just saw this candle like this, and now I think the market's going to go higher. All right, fine. I'm good with that too. But the bottom line is, the beauty with this trade is we are going to be able to isolate just about everything. So you might as well give yourself a longer duration in order to be successful, because it could be some bumpy roads in the beginning and might not necessarily go below where your out would be, but then it takes off, right? So we want to give ourselves a lot of time to be right. And, we want to know which spots we're going to want to visit along that route, right? We're going to make sure that what we're looking at is, if we're going to go along this road and places we're going to visit, what ultimately I'm talking about is our strike locations, right? So our spots we want to visit for this strategy, if we want it to act dollar for dollar along this route of what XRT does in our portfolio, we need to buy an at the money call. Now remember, we talked about deltas. Deltas for the calls are positive. So we're buying a 50 delta, right? So this 50 delta for the first for a dollar move higher, we get a dollar move up. Well, this call is going to increase by that 50 cents, right? So we got a dollar move higher, it increased by the 50 cents. And we're going to sell this put. Well, remember, delta for puts is always negative. Well, we sell a put, we're selling a negative delta, which means that's a positive delta, right? So we had a positive delta here, right? That equals 100. So for a dollar move higher in the underlying, our premiums or our strategy is going to increase by $1, right? Or 100 deltas. We talked about this earlier, right? If you buy 100 stock and increase by 100, or increase by $1, we get $100. This one, we buy a one lot, it increases by $1. Our premiums increase by that $1. And remember, options are equivalent to 100 of the underlying. So if you're used to buying 100 XYZ, then you're buying one lot in the options, okay? Because an option contract is equivalent to 100 of the underlying. And also, you'll see that in your P&L. When you're looking at the option montage, you got to remember it is in pennies, right? It's 50 cents or whatever. But if you go and buy that one lot, it all of a sudden flips it. It multiplies it by 100, and you see that it is not 50 cents. It's now would be $100. Okay, or $1. It's actually $100. All right, so we're buying a call, buying a 50 delta, selling a negative 50 delta is a positive. Now we're positive 100 delta. So this, for a dollar increase in XYZ or XRT, our premiums are going to increase or be offset so that they act dollar for dollar with that underlying. All right, what about theta, that thief in the night, right? Well, it's very similar. We can look at this. Think of this as we bought the call, right? This is the out the money call, the out the money put. All right, I probably shouldn't scratch that out. Sorry, let me get my eraser. All right, so we're buying a call and we're buying or selling a put, right? So I'm just trying to make sure I still have that set up right. So if we buy a call, theta, the thief in the night, starts eroding at our premiums, right? That hurts us. But if we sell that put, we want that theta to come and eat our premium, right? So that helps us. So they really start to offset one another. And we can look at it on the option montage when we go and look at it. But basically, remember, we're buying a call. That means we paid premium for it. And that thief is going to hurt us. But because we're kind of going at that same strike, then that thief in the night that comes and steals our premium on the put side, since we sold it, we want those premiums to go down. So they're offsetting, okay? Same thing if you think about it. If we bought the call and volatility goes higher, it helps us. If it goes negative, it hurts us. But on the other side, we got those puts, right? We sold those puts. So if volatility goes up, it hurts us when it helped us on the calls. And if volatility goes down, it helps us, but it hurt us on the calls. So they're offsetting each other, all right? So we're able to isolate that, right? We've created a situation where we're isolating it just to get to delta, right? Yeah, gamma's going to do the same thing, right? Second dollar move higher. All of those levers and pulleys are going to happen. If this starts moving in our favor, the deltas on the calls are going to get bigger and the deltas on the puts are going to get smaller, all right? But they are going to add up. When we add it all together, it's still going to be very close to $1, okay? We lose a couple pennies here and there. Yes, that is a downstroke of using options. It's not going to be like all of a sudden you're looking at the strategy and it went from basically 100 deltas to 50 deltas. That's not going to happen. What will happen is it might go from 100 deltas, and worst case scenario, you're looking at 98 deltas. So you're missing out on 2 pennies on a dollar move. Well, the flip side of that is we put up half the margin, you know. So we're kind of looking at like, okay, well, this strategy saved me about $2,000 in margin. Do I care about that 2 cents on a dollar move? You know, or a $10 move and it costs you 20 cents when I'm saving you, $2,000 on the margin requirements. That's the trade-off. And I think it's well worth it, right? So what vehicle do we use? We're looking at the synthetic long, because when you create this strategy like this, where you have 100 deltas, it acts dollar for dollar like the underlying. We've gone over that, right? So a couple of the benefits with the risk reward on this is it's equal to the underlying of the stock, all right? So we are also using 50 to 75% less capital. And that's what I'm talking about with the margin. If you can buy stock on margin, all right, then this is going to save you 50% less than that. If you are able to, if you have to basically go out there and buy stock and they don't give you margin for it, then this is going to save you about 75% the capital that you would normally put out. So like $100 stock, right? And you bought 100 of them, we're talking about we got to put up $10,000. Well, with this strategy, you would have to only put up 2,500. And if you can buy that stock on margin, they usually give you 50% margin, right? So you buy $100 stock that costs you $5,000. Well, this is 50% less than that. It's 2,500. All right. And when you use less capital, but you get the same amount of return as the other guy, well, your return on capital goes through the roof. So if you've heard people talking about your return on capital and that being a big thing, options is really how you jack up that return on capital vanity metric. It really is only a vanity metric. I don't really talk about return on capital other than, that's why I use options, is because of my return on capital. I can do a lot more in my portfolio with options than I can with stock. So why not? All right. Isn't the short put having a positive delta and the long call has a positive delta? Yes. And the two positives are equal to one. I'm just going to end it there. Yes. Now, when I'm talking about positive delta, all right, what I'm saying is it's a positive to your position, okay? So if I sell a put, all right, if I sell a put, then that means that the delta is a positive to my position, all right? It's not actually adding in on the dollar move, okay? It's still coming out. But what I'm saying is a positive dollar move, right? A positive plus a negative delta, it's still a negative delta to the put I sold. But that's a good thing, right? Because that's a positive to my position. We move higher. I want that thing that I sold to go down in value. All right? Does that make sense? So what I'm saying is if my 50 delta call, we move up by $1, that 50 delta call moves up by 50 cents, right? And that 50 delta put moves down by 50 cents. Well, I've just made $1. Does that make more sense that way? Everybody? Think about it. If I'm doing it right at the money, I'm doing the same strikes, and the underlying goes up by $1. All right, underlying goes up by $1. My call goes up by 50 cents, goes up by 50, right? And I sold a put. So, if I bought a call, we go up by $1. I bought that call at, let's say, $1. It goes up to $1.50. And let's just say on the put side, the put, I sold this, right? At a 50 delta. Well, now my premium in the put side that I sold goes down by 50 cents, right? So this goes up. I bought it for $1, this call for $1, goes up to $1.50. I bought this put for $1, and now it goes down to 50 cents. Goes to 50 cents. So basically my call goes up by 50 cents, my put goes down by 50 cents. Well, that's perfect, right? The one I bought goes up by 50 cents, that's 50 cents I get to keep, and the one that goes down by 50 cents, that's better for me also because I can buy it back cheaper. I can sell that one for more, I can buy this one for cheaper, and it offsets. Or that's that $1. Delta is always positive when you buy a call and sell puts, but negative when you do the opposite. All right. When you buy a call, all right, and that's a positive delta, right? Meaning if it moves up by, and when I'm saying that, what you have to think about it is delta, it doesn't really change. It doesn't discriminate whether or not you bought or sold it, all right? What we have to think about, and what I'm trying to get you guys to get in your heads, is that we have to put this in relation to what our position is, right? So if I bought a call and it goes up by $1, those premiums increase by that delta by 50 cents. Now, if I sold that same call, delta is a negative to me, right? So if it goes up by $1, my premiums increase by that 50 cents, right? So that's a negative to me, right? that hurts me. If I'm selling a call, I want the market to go down. I want those are negative deltas in a sense. It's the probability we want it to go down, right? We want those deltas to be negative. Okay, so it's thinking, and this might be confusing because this is how we used to be on the floor. Like we used to talk about delta, like, you know, what's the delta of, you know, this baseball team winning this weekend? And we'd be like, oh, it's about a 75% delta. Well, that's a pretty good chance that baseball team's going to win. You're saying it's, you know, 75% chance, but we'd always just say delta. So thinking here is to wrap your head around how delta works for you and works against you. So if I sell a call, I want negative deltas. I want the market to go down. I'm bearish. Okay. If the market moves higher, yes, it's still going to add into those premiums, right? But I'm bearish. That's hurting me. Okay. So if you sell a put, now, yeah, those are negative deltas. But if I sell a put, then those are positive deltas in the sense that when the market moves higher, that's positive to my position. Okay. So I sell a put here, my premiums go down by 50 cents. Well, that helps me out, right? I sold it at $1. I'm buying it back at 50 cents. That helps me. That's a positive to my position in a sense. I buy a call and the market moves higher. That 50 deltas goes into my premium. That helps me. So all in all, my position increased by $1, right? If I went from $1 to $1.50, that increased by 50 cents, and I sold the one for $1 and I could buy it back for 50 cents. Well, that's $1 flip into my favor. Makes sense. Okay. Everybody clear? Because there was a couple of questions that were all the same. I want to make sure that's clear for sure. All right. So direction, we got the bullish assumption, right? Destination. This is all about, you know, the less than or equal to the 10 cents, right? In the option montage, or we move the decimal 3 ticks to the left, all right? The environment. We've offset that environment, right? I'll show you here in the detailed description. The duration, we want long duration. Why? Because we're offsetting data, right? We've got the thief. We don't have to worry about the thief. We're offsetting. We actually have two thieves. We've got one that's hurting us. He's coming and eating away at our calls. Same thing. We bought those calls. They're going down in value every single night, but we sold those puts over there, and those are going down in value. So they're offset, right? And the strikes, we want to be equal to 100 deltas. And you're not always going to get exactly 100 deltas. Sometimes, like I said, it could be 99 deltas. Sometimes, though, you can get 101 deltas, which means it's acting a penny better for you. It just has to do with the way it's all getting set up. All right. Max profit is unlimited, just like a stock, you know. You're going to have a stock like Tesla go from, you know, $1.50 to now $1,200 or something, right? So it's pretty much unlimited to the upside. And the max loss is this underlying goes to zero. Just like you go out and buy a stock, tomorrow if it goes to zero, you're going to lose all of that. Keep in mind, you know, one of those things I talked about, the synthetic long stock, is you aren't getting a dividend. That's a downstroke of that. All right. The break even is our long call strike minus a credit. So if we get a credit for this strategy and I bought the 100 strike and I get $1 credit, well, that means my break even is 99. Keep in mind though, that break even is going to be very close to where the underlying is trading. All right. So if you do the call strike price minus credit, that underlying, like I said, you bought the 100 strike, you basically got $1 credit. That underlying should be trading around $99. All right. Vice versa. If I bought the 100 strike and I pay $1 debit, pay $1 for this strategy, well, then it probably should be trading around 101. So that's one of those things I was talking about with the pricing that, you know, yes, we're going for the longer duration. We already talked about that. We talked about how those markets get a little bit wide. Well, you know, free market price discovery might not be going on in full swing out there. Well, the beauty in this strategy is we know where the underlying is trading right now. Worst case scenario is we build our strategy to where the break even is right where that underlying is trading. Sometimes you can get it better. A lot of times you're going to be able to do the synthetic long strike where, you know, the underlying is trading at 106 and you're basically able to buy it at $105.50 or $105.75, right? So, sorry, my son just brought a friend home and I was worried that they were going to be able to smell somebody new walking into the house. All right. So we know we're taking XRT, right? We're taking this. We have to know where we're going to get out on a winner and a loser. All right. So this is where we have to do some soul searching. I can't give investment advice. And this is where it gets a bit of a gray area, right? Because this starts becoming very investment advice-y. Just like I can't tell you to go out there and buy XRT because I'm bullish in it. I would never do that. But what I suggest you do is when you come up with your assumption, you know that you have your ins and your outs. So with XRT or something like that, and we're looking at this trade, you know, for me, I would say something like if it broke below this area right here, I want to be out. If it gets below the 200-day moving average. Maybe you have on Fibonacci's and you're like basing it on it bouncing off of Fibonacci or something like that. Stick with that stuff, right? How much would you be willing to lose on a stock? Are you going to ride it into the sunset? Well, maybe, because you really believe in it over the long term. Well, then that's your investment assumption, right? You want to ride this out for a year. You can go out 2 years on these or whatever and do it. You know, you just want to stick this in your portfolio and you're going to ride it like you would a regular stock, okay? For me, though, XRT, I think XRT, and I have it on a different chart, but basically XRT is hitting a trend line for me. So I believe XRT is at least going, you know, going to continue to, let's just say, trend like that, all right? So I believe XRT is going to keep going. Oh, this is the XRT. I was thinking the technology. I don't want XRT. For some reason, I got that in my head. I want XLK. I want the ETF for technology. I don't want retail. Sorry, guys. But XRT, I'm going with, you know, we're going to continue to trend. All right. Yes, one could say, yeah, it looks like it's ready to roll back over, test this. Maybe you wait, whatever. I'm in XRT, or sorry, XLK. I want to be in XLK for a while. I think XLK, because it has the technology sector, that it is going to do well. People are Microsoft, you know, anything that has to do with a home office is going to do well because people are doing it. You know, if you worked in an office and you had Adobe Suite there, well, you came home, you're probably, or your company is probably having to buy Adobe Suite for your home computer. All right. You know, if they didn't give you a computer to take home, but you know, all of those things are going to start being purchased going forward. All right. So XLK, stop it, Eric. Stop it with the XRT. XLK, we can see fits my rule, right? I've got a bullish assumption. I just came up with it. I showed you guys my bullish assumption in that. All right. So I don't want 15 days, right? I want to ride this out for a while. And we can go and look at, I'm probably going to go probably no further than December because, you know, I'm a shorter term trader. Now, you will see that you will be able to probably go out further and it's not that big of a deal. I'm just probably not going to, we'll check it out. Usually when you get 500 days out there, you're probably going to pay a little higher than where the underlying is trading. But let's just look at this strike right here on open interest we had for earlier. You can still see there's pretty good open interest and daily trading going on here. But let's look at buying and selling all of this. And markets are really wide right now. Why? Because we're after the close. But two, we're going to be able to figure out our pricing. So I'm going to buy this one. And then I'm going to go over here and I'm going to sell this one. So you can see I'm paying a debit. Now remember, a debit adds in for our break even. So if I was able to put this strategy on right here, I'd be paying 105.13. Well, you can see 105.13 is lower than the bid. Now, do I think I'm getting 105.13? Probably not. I'm probably put this in as a trade. Eldon, put this in as a trade and hopefully get it. But then I would do a cancel replace, you know, enter the trade, confirm, send, come back. I'm not waiting 15 minutes, about as long as it takes me to go through the process is what I'm going to do. And then, you know, I'm probably going to have to move it up a couple of pennies at a time, really. But my guess is I'd probably be getting filled somewhere with a 30-cent debit. Okay. Now, one thing to know, let's just go back real quick. 53 deltas, 47 deltas, right? I'm buying 53 deltas, selling a 47 delta. That's 100 deltas. I've got my 100 deltas. Now, I'm going to forget about gamma because gamma is offset, right? Also, because if we're moving $1 higher, gamma comes out of, I'll do it anyway, I'm talking about. Gamma comes out of this, so it'd go down to 45 cents, right? On that first dollar move. 47, negative 47 plus a positive 2, we go 45 on the second dollar move. Well, over here, this one's going to go up to 55 cents, right? Because gamma goes into the delta, and now we have 55. So now we have 55 on the call side, 45 on the put side, still 100 delta, right? Now, theta. Tomorrow, we come in, and it's a new day. This goes down by 2 cents. We bought it. That hurt me by 2 cents. Over here, that theta comes out tomorrow. Well, I sold it, so that's good, right? That helps me. Those two offset. All right. Now the Vega, same thing. I bought one. Vega goes up. That helps me on the one I bought because my premiums increased. But that Vega on the flip side that I sold goes up by the corresponding Vega. They're offsetting. You can see they're the same numbers. So that is a good thing to my position. So those are all offset. Really what we need to worry about is where our pricing is for this strategy, that our break even is right in and around where the underlying is trading. That's what I want. Okay? Does that make sense for everybody? So it's a pretty simple strategy. And as a matter of fact, you know, we can go and check out, actually, you know what I wanted to do? Belden, please. You don't understand I'm on a webinar here. Nobody wants to hear you. All right, so live TV. Anyway, so the purple line is what the underlying is. The blue line is how the strategy is performing. So you can see dollar for dollar, those are moving in tandem with one another. All right, so they are acting the same, right? You know, if I were to do something like, you know, change the strikes or something like that, you're going to see that it changes, right? Those would not be acting exactly the same, all right? So now we've created a situation where they're acting exactly the same. Now, when we're talking about the rounding errors that I was talking about with the deltas, you can see over here right now, the delta where my cursor is not exactly dollar for dollar. All right. So you're going to lose, tenths of a penny there, here and there. So that's why it doesn't exactly track it on top of one another. Okay. Let's go back to the trade, and I'll do one more real quick one where we're going to look at, and then I'll hit you up in a minute on the gosh, I don't remember what your stock was though. All right, so let's take a look at this. The same one, 105 strike. We're going to look to buy this one, selling the 105 strike. You can see 55 delta, 45 delta. We got 100 there. We already know all the other things are offset. One thing to see here though, we're getting a 55-cent credit, right? A negative 55-cent credit. I'd have to do the math to see if that's 15. So that's a debit. I'm paying a 55-cent debit there. It's a negative credit, which means it's a debit. You can see that if I'm buying $15 and selling $13 or even mid-market somewhere, I'm probably going to be doing a debit. But again, even though these prices are really wide, way out, almost 2 years away, 2.5 years away, or sorry, a year and a half away, you can see that, well, for me, coming up with a price for these underlines is going to be very difficult, right? Where do I price this? Well, we know it should be very close to where that underline is trading. So I'd probably have to make it to where my negative credit, which is a debit, is going to be somewhere right in between there. So that's kind of where I would. You might have to pay a little higher than where the offer is when you get this far out in time, okay? For one, there's not a whole lot of eyeballs out there. People aren't willing to take that much risk. So they're going to make you pay off for some of that risk they're taking on for this long duration trade. But keep in mind, when I look at this trade, let's just go back to the one that was a little bit more realistic. So buying this one, selling this one. And, if I bought 100 of the underlying, this is the last thing I really wanted to talk about. If I go to the confirm and send, and I don't know if I'm breaking rules here, you can see the buying power effect for a one lot is $2,800. Now, if I were to go out here and just buy XLK, you can see that it's an ETF, so it's not quite 50% less, but definitely a lot better. $1,500. If I were to do it with like eBay or something, I'd probably do eBay real quick and say, if I bought eBay on the offer, $2,700, and if I did this strategy, let's go to the 55, buying this one, selling this one, make it a one lot, make it right equal to what the underlying is. The one lot would be equal to 100 contracts. Confirm and send, you can see it's about half that. That's why we're doing that, right? If I can do half my capital outlay, if I have limited margin, then I can continuously build out my portfolio there, all right? Okay? So that's why we do it. But you have to come up with your own on this one, especially because it is a high risk trade, because it's just like, they'll tell you going out and buying a stock is not high risk, but you build out a option strategy, all of a sudden it feels different when you start seeing your P&L fluctuate. Well, keep in mind, you're buying the underlying, quote unquote. It's a synthetic long stock. All right. Any other questions there? So, I didn't really answer this question, but for me, it's like stick with what you know. If I'm picking, XRT is going to start tracking higher. I'm probably going to ride this out for a while, but if it breaks below that area I showed you, that's where I'm out. It starts, it kind of could be consolidating here. I'm not worried about that because I've limited the theta decay and everything else, right? But if it starts trending sideways, like we talked about, that I'm not too concerned about that. If it breaks below my support level, I'm out. I'm going to pull the ripcord on it. Cool. All right, you guys, getting very close to having full membership on this. First 100 members become charter members of the Wolfman Options Lab program. We are very close. So if you are holding off on that, jump on that quickly. Alexander, don't worry about interruptions. I want to make sure everybody is clear of concept on everything. So I would never, I'll take this webinar 2 hours long if people have questions. So don't worry about the interruptions, please. I want the questions. Besides the fact that you guys drive content, you know, if you have a question, somebody else has the same question. You know, it just means that I may not be explaining it so some people understand it. You know, that's I'm doing it a little bit different in this webinar than I have done in the past, and I had great success with those ones in the past. But you know, different things click with different people is why I'm trying to do it this way. So take advantage of this. I'm going to throw this link over in the chat window right now. Hopefully I still have the link. Paste there. Yes. So the link is over in the chat window. Go ahead and click on that because I don't have the web page up to let you scroll through all of the stuff, but there are hundreds of hours of content. If you think about each one of these webinars going, you know, a little bit over an hour, you know, there's hundreds of videos on there, and there's even short ones. They're not all an hour long. I'm not going to bore you guys with all this. As a matter of fact, there's some short ones like on the synthetic long stock where it's like a 15-minute, just a bang, real quick refresher. I'm not really drilling down on it in too much detail. So you can check those out as well. You get all access to that for the membership here. You also get free upgrades for the future webinars and different discounts that other people aren't going to get for all of our content for that matter. And also you get the question and answers office hour sessions where you guys, I know a lot of you guys have been taking advantage of this question and answers, you know, reaching out to me. That's what we do for our members. I am going to get on the phone if I have to with you guys and make sure we hammer this out. So if anything is clicking with you in this webinar, you're like all of a sudden, hey, you know what? I get this now. I see, I'm trying, you know, I get how he's teaching. Take advantage of this because you guys will learn so much more. By the time you go through all of my content, you guys would be able to do the webinars probably better than me because I'm not a great webinar presenter maybe. But let us know what's working for you guys. You know, reach out to us. I want to thank you guys all. You can get a hold of us at 310-598-6677. Email us at trading@protraderstrategies.com. Also, here is the link that you will have to type into your URL. If you're on this webinar, though, the link should be over there in the chat window, and you'll be able to see all of that content. Like I said, I don't want to scroll through 100 different option webinars that we have in there. So with this one, you can take advantage of it, scroll through it. You can check them off. After beauty in our platform is you click the little box and you know you've watched it. Actually, I think the box is already clicked. It shows you how much you've watched of it even. So for 97 bucks a month, you can take advantage of that. Yes, you can go online, find out how to do the synthetic long stock, but they aren't going to go through the details of what I've showed you. And they aren't going to have these little nuances and little trader hacks to come up with, like knowing how to price it out. You know, they're not going to tell you how to price it out. They're just going to give you the basic stuff. I've given you that little tidbit there for helping you out with building out a synthetic long and how to figure out pricing in those back months when it's a little bit bag, right? So go ahead and take advantage of that. Like I said, it's in the chat window. What was that other, Prakash, if you're still around, what was that underlying you wanted to take a look at? Come on, check out the stock, BILI. Oh, did you just type it in twice? I was going to say, because I've never seen it. I don't think they have ticker symbols that long. What is it? BILI. Oh, Billy. I've never heard of it. What does it do? All right, that's about it. Other than if you guys want to stick around for a couple moments longer, I'm going to go over a couple other examples that some other people had come up with. In the meantime, you can scroll through that stuff while I'm chatting it out. What does that stock do? I don't think they have probably very good options. Oh, they do actually. Why haven't I heard of this stock? I'm gonna have to take a look at it. Matter of fact, I'm just gonna add it over here first. I'll add it to my main watch list in a little bit. Look at that. See, that's why I love you guys. You can take a look at that stuff. Billy. All right, I'll take a look at it. I don't know about that candle though there. Kind of looks like my Tesla trade. Those are the ones where I like to start putting on some negative deltas. Didn't work out there though. You can see, broke that pattern. Gosh, what was your trade? I don't remember what it was. Can't find it now. All right. Guess that's it then. All right, you guys. That's all I got for you guys. Have a great 4th of July. Come back next week with all your fingers. Make sure you aren't doing anything crazy. All right. Have a nice one.